Imagine one morning you open your eyes, pick up your phone, and see the same headline flooding every page. World oil price breaks the $200 per barrel mark. On the screen, it's just a single tall green candle on a chart, but outside your window, a chain reaction has quietly begun. Because behind each barrel of oil, there isn't just a tank sitting on an oil tanker offshore, but an entire gigantic system of trucks, airplanes, ships, power plants, fertilizers, plastics, chemicals, food, inflation, unemployment, and political decisions made in closed meeting rooms. The $200 mark is not just a number, it is an alarm bell for the entire growth model the world has relied on for decades. Today, the world consumes more than 100 million barrels of oil per day. At a price of $80, the daily global oil energy bill is already around $8 billion. If the price is pushed up to $200, paying for the same amount of oil suddenly jumps to $20 billion a day. That $12 billion difference multiplied day after day, month after month, can add up to more than $4 trillion a year being pulled out of the pockets of consumers, businesses, and governments. Set next to global GDP of around $100 trillion, this shock looks like an unexpected tax equal to a few percent of the world's output, paid just to get the same amount of energy as before. There is no shock of this kind that doesn't leave scars on the economy. The last time the world truly panicked about oil was in 2008, when crude prices hit the range of $145 to $147 a barrel in early July, before plunging to around $40 to $50 in just half a year. At the time, that was already a historic record, accompanied by a global recession many people still remember. Now, a $200 per barrel scenario means the world would have to live with a price nearly 40% higher than the 2008 record, in a context that is far more complicated. Higher public debt, longer supply chains, continued heavy dependence on oil and transport, and much thinner policy space for many governments after previous crises. Oil still accounts for roughly 1/3 of total primary energy globally. If you look specifically at road, air, and sea transport, dependence on oil products is even higher, exceeding 90% in many countries. That means every time you move, every time goods are moved from factory to port, from port to supermarket, from warehouse to store, the economic system touches oil. When the price of oil rises from $80 to $200, there is no segment in that chain of motion that is spared. The first place you feel the shock is not on the trading floor, but at the gas station near your home. There is a tacit rule analysts in the United States have often mentioned. Every $10 increase in the oil price, if sustained, can raise retail gasoline prices by about 25 cents per gallon and take around $25 billion a year out of consumers' pockets in the U.S. alone. From $80 to $200 is an extra $120, equivalent to 12 such steps. Multiply it out, and the U.S. economy alone could lose roughly $300 billion of purchasing power each year to fuel costs, not counting indirect costs. For an economy with a GDP above $25 trillion, that figure doesn't make it collapse overnight, but it acts like an invisible tax hitting commuters, long-haul truck drivers, and families juggling every expense. At the macro level, central bank studies have indicated that every $10 increase in oil prices, if maintained, can shave about 0.1 percentage points off GDP growth in major economies and push inflation up by about 0.2 percentage points. In Europe, models from the regional central banks suggest that every 10% rise in oil prices can lift inflation by about 0.1 to 0.2 percentage points. From $80 to $200 is an increase of roughly 150%, equivalent to an additional 1.5 to 3 percentage points of inflation coming purely from the oil channel. This puts central banks into a classic dilemma. Inflation is rising not because demand is booming, but because input costs are being forced up. That is cost-push inflation, a type of inflation that is very hard to control with interest rates alone. Raising interest rates cannot create a single extra drop of oil, cannot immediately cut pump prices at the gas station, but it can choke off investment, weaken the labor market, and push the world faster into the swamp of stagflation, where growth is stagnant and prices stubbornly remain high. If you follow the money flow backwards from the gas station to the factory, you'll see how far the impact spreads. In steel mills, cement plants, chemical factories, plastics plants, every liter of fuel burned in the furnace, every ton of oil used as feedstock becomes more expensive. Many heavy industries and chemical producers use oil not only as fuel, but as a key input to make fertilizers, plastics, synthetic fibers, and solvents. When oil prices rise, the cost to produce a ton of steel, a ton of cement, a ton of fertilizer, a ton of plastic is pushed up. Businesses face a hard choice. If they raise prices, they risk losing market share. If they hold prices, their profit margins are eroded, even turning to losses. The result is usually a blend of both. Part of the cost is passed on to buyers. The rest is covered by cutting other expenses, including labor and new investment. In aviation, fuel often accounts for between 1/5 and nearly 1/3 of total operating costs. You can picture what happens if the second or third biggest cost component in your structure nearly doubles. Low-margin routes instantly become burdens. Airlines are forced to raise fares, cut frequencies, postpone plans for new routes, shrink their fleets, or renegotiate everything from pilot salaries to in-flight meal contracts. International tourism, extremely sensitive to ticket prices, slows down. Tourist cities, from Mediterranean beaches to Asian tourism hubs, will clearly feel that peak seasons are no longer as crowded, that hotels have more empty rooms, and restaurants can't fill all their tables on weekends. Maritime trade, the backbone of globalization, also comes under heavy pressure. Fuel surcharges are a substantial part of the cost of shipping a 40-foot container from Asia to Europe or the United States. When oil hits $200, fuel costs for each voyage can rise by tens or even hundreds of dollars per container, depending on route and vessel. Across the millions of containers moved each year, that extra cost becomes enormous. Shipping lines will be forced to raise freight rates. Imported goods, from clothing, shoes, toys, and furniture to electronic components, all become more expensive. The end consumer, who never sees a single drop of oil, still pays more for it through every item on the shelf. Oil at $200 doesn't only create losers, it creates big winners as well. Every day, with output of several million barrels, a major oil exporting country can earn hundreds of millions of extra dollars compared with when prices are around $70 to $80. In a year, that can translate into tens or even hundreds of billions of dollars in surplus. State budgets swell thanks to oil taxes. Sovereign wealth funds in these countries suddenly have vast sums to buy assets around the world: shares in major corporations, government bonds, and real estate in financial centers. In oil-rich cities, you'll see more luxury cars, ever grander infrastructure projects being announced, towers, stadiums, and highways mushrooming. But the picture is completely reversed for net oil-importing countries. In particular, developing nations with thin foreign exchange reserves, high public debt, and weak currencies will find themselves in an extremely difficult position. Every extra dollar per barrel means a higher energy import bill. To keep the lights on, fuel available for transport, and enough fertilizer for agriculture, they are forced to spend more foreign currency. The current account balance is stretched tight. The local currency comes under intense devaluation pressure. As the currency weakens, import prices climb even further, creating an inflationary spiral. In these countries, the $200 shock is not only an economic crisis, it can easily morph into a social crisis when governments simply cannot afford to subsidize fuel or food, driving people into the streets, sparking riots, and turning political instability into a tangible threat. In the slums of big cities in these nations, higher gasoline prices mean the old bus that carries workers from the outskirts into the city will raise fares. Higher oil prices mean imported fertilizer becomes more expensive, and farmers must pay more for the next planting season. Increased transport costs mean that bags of rice, bottles of cooking oil, and packets of instant noodles at the market all edge up in price. Poor families, who already spend most of their income on food, fuel, and rent, now have almost no buffer left for the shock. A few extra dollars a day for them is not just a number. It is the decision between eating enough or going hungry, between sending a child to school or keeping them at home. In the gleaming glass offices of major central banks, charts and economic models are not just theoretical exercises. They see the scenarios very clearly. If they sit still, inflation will overshoot the target, trust in the currency will erode, and savers and investors will demand higher interest rates to offset risk. If they respond by hiking rates aggressively, they know they are slamming the brakes on growth, making it harder for businesses to borrow, cooling housing markets, and potentially boosting unemployment. This situation becomes a textbook example of the monetary policy dilemma in a cost-push inflation environment. At its core, the problem is a lack of oil or oil being too expensive, not that people are spending too freely. Interest rates can crush credit demand, but they cannot open a new oil well. From a historical perspective, oil shocks have always marked turning points. In the 1970s, two oil shocks within less than a decade turned Western economies from accustomed high growth and low inflation into prolonged stagflation. Prices soared, growth stagnated, unemployment climbed. At the dawn of the 21st century, the jump in oil prices above $140 occurred right before the global financial crisis, not just as a symptom, but as part of the pressure-squeezing purchasing power and confidence. If the $200 scenario emerges, it will once again magnify today's weaknesses: mounting public debt, widening income inequality, heavy dependence on fossil fuels, and sprawling cross-continental supply chains. When oil prices are excessively high, everything once considered far-fetched in the energy transition suddenly becomes financially sensible. Solar power projects that used to take many years to break even can now recoup investments earlier because electricity from oil and gas has become so expensive. Electric cars, once criticized for high upfront costs, become the more economical choice when compared to paying for gasoline at the new price throughout a vehicle's lifetime. Forecast models from major energy organizations all suggest that while oil will remain in the energy mix until mid-century, the share of renewables will grow steadily, and wind and solar capacity can expand far faster than previous cautious projections, especially if fossil fuel prices keep breaking higher. At the micro level, the story doesn't stay on strategic reports, it goes straight into the choices of each family and each business. A suburban household owning two gasoline cars may start seriously considering swapping one for a hybrid or electric vehicle, not for the environment, but simply because the monthly fuel bill has become unbearable. A mid-sized logistics company will revisit its entire system, optimizing routes, cutting empty trips, upgrading its fleet to more fuel-efficient models, and slowly investing in electric trucks for short, fixed routes. Those small decisions, multiplied millions of times across the globe, add up to a wave of change in energy consumption habits. On the geopolitical front, oil at $200 turns every pipeline, every export terminal, and every tanker route into a strategic asset. An embargo, a regional conflict, or an attack on energy infrastructure will not only shake the immediate region. It can set off a new wave of global price spikes. Energy alliances, production agreements, and strategic stockpile commitments are recalculated. Nations with large reserves, strong extraction capacity, and stable export systems become focal points in the race for influence. Import-dependent countries are forced to diversify suppliers, build more storage, and invest in domestic and renewable energy to lighten the weight of each move in oil prices. If you pull the camera back, you'll see that the $200 per barrel scenario is really a stress test for the entire system. That system was built on the implicit assumption that energy would always be cheap and easily available, enabling supply chains to stretch halfway around the globe, letting people drive tens of kilometers every day, and allowing billions to fly back and forth between continents. When one of those pillars, oil, suddenly becomes very expensive, all the other parts shake. Numbers like 100 million barrels per day, several $1 trillion in extra annual costs, 1 to 3 percentage points more inflation, and hundreds of billions in eroded purchasing power are just the outer shell of the story. The real content lies in questions like, how many businesses survive? How many jobs are lost? How many families must change their way of life? How many countries sink into instability? In those individual stories, you see more clearly what the number 200 really means. It might be the decision to postpone a long-planned vacation after years of saving. It might be pulling a child out of a private school and moving them to a public one because every other expense has ballooned. It might be protests over fuel prices that clog the streets. It might be fierce debates in Parliament over whether to use the budget to subsidize fuel or to keep the money for hospitals and schools. It might be tense meetings between companies and unions over overtime, pay cuts, and layoffs. At a deeper level, the $200 per barrel mark is like a mirror. It reflects our degree of dependence on fossil energy, the fragility of supply chains, and the asymmetries between oil-rich and oil-poor countries, between the wealthy, who can absorb the shock, and the poor, who are pushed to the edge. It reminds the world that every liter of gasoline going into a tank, every ship leaving port, Every plane taking off rests on a finite resource and on a price structure that can change its face very quickly when something goes wrong. The world cannot keep treating that $200 candle on the chart as a distant scenario and then forget about it whenever markets calm down for a while. The key question is no longer, can oil prices ever reach $200 a barrel? Because history has repeatedly shown that prices once thought impossible can be reached in special circumstances. The real question is, do we have the will to carry out the necessary energy transition, to change consumption patterns, to diversify supplies, and to build a less fragile system before the $200 alarm truly rings? Or will we wait until that day, only starting to act when the shock has already struck the lives of billions and the less painful choices are no longer on the table?